My name is Juan. I'm the OC agent here at Nationwide Real Estate Executives. I service all of Orange County and sometimes Riverside, Kern County, LA County, depending on whether or not I'm helping an investor. Sometimes they want to go out further for cash flow. Today, we have Phil Atwan, expert in 1031 Exchange, and he's going to go through some information that is critical, especially in today's not only real estate economy, but also in general with politics and all the things that are going on in our society. So, Phil, why don't you introduce yourself, and we can take it from there.
Juan, thank you, and good morning, everybody. It's really a pleasure to be with you via Zoom here this morning. Today, I want to talk with you as investors, as you as real estate agents. You know, investment real estate is an incredible commodity for us to invest in. Of all the people who are the wealthiest that you probably know, how many of them own investment real estate? The answer is, I got to say the majority of them do. And I'm an investor, and we're investors for specific reasons. And I'd like to talk a little bit about that today and go through some of the basics of the 1031 Tax Deferred Exchange and what the government has given us that is now allowable for us since 1921. And that's when the government first gave us this thing called an exchange. So I'm going to screen share right now. Juan, if you can enable me to share my screen.
Excellent.
Great. So all you should see now is the screen and maybe a little corner with me in it. Oops.
I do see you there.
Good. I don't mean to scare you with my picture, but it is
perfect.
close
Hey,
to
we're
Halloween, right?
yeah, exactly. We're getting close to Halloween.
Yeah. And by the way, you'll remember this presentation because Halloween is what? 1031, right? October 31st. So
I love that. Yeah, good job.
All right. All right. Enough of that. Okay. Let me get this going. All right. First of all, what's the motivation of owning property? It's my motivation. And for any of you who are investors or work with investors, this is the most important thing. There's three items. Number one, it's monthly income. Monthly income is what pays the bills. Monthly income generally goes up over time with inflation. Property values make the monthly income go up. You want to own, if you want to get paid once a month, you own a condo or a single family, it'll pay you rent every month, as long as it's occupied, right? Number two, if you think about it, if you want to get paid once a week as opposed to once a month, you have 4 single families, 4 condominiums, or 2 duplexes, or a 4-plex, or whatever. But you get 4 units that you own, 4, well, I call them front doors. And those front doors will pay you a rent check every week. If you want to be paid every day in investment real estate, you need to own 30 doors. And you get a paycheck every day. So the bottom line is, what is my motivation for owning this? Income. But income is broken into 2 categories, and I want to talk about those categories today. One is called the rate of return. The other one's called cash flow. They're different, but they all translate into income, and I'll talk a little bit more about those a little later. Number 2, what's my second motivation? Well, that old saying, I want to have my cake and eat it too. And what that basically means is I want to have income, but I also want it to appreciate. If you go into the stock market, all you basically get is appreciation. Hopefully that your stock goes up. But investment real estate, you get appreciation. Over time, the value of the asset grows. But you also get income to go with it. So you get your cake and eat it too. That's a very big part of an investor's portfolio. The appreciation means more to us before we retire than after, because income means more to us later after when we retire. So you want the appreciation mode to be very strong until it's time to hang it up in your late 60s or your 70s or whenever you're going to retire. But you want, and then the cash becomes king to you because that's what you live off. But the appreciation will help you to releverage to create more front doors that are going to create more income. You'll see that in a minute. The third item that's so important, Juan and I were just talking about this in part, it's called depreciation. It's tax write-offs that allow us to reduce the income taxes that we pay on the rent we collect. Did you know that every time you collect a rent check, The government wants their part. You know, I have 5 words I'd like to share with you today. If you can remember these 5 words, you will change your lives. And here's the 5 words. You ready? Don't ever forget this. The government wants your money. And that's the bottom line.
Yep.
The more you
I think it is an allergic reaction because look at my neck now. It's not
Did
as
somebody
bad,
mute
but
themselves
it's
who's
still
having a
there.
conversation
But it
back there?
it changes really like
Who is it?
dramatically.
It says D
You-
on there, so whoever D is.
You do have an allergic reaction.
Yeah.
I think it's allergic.
There we go.
You got that one?
Yeah, got it. We're muted.
Okay, good, thank you. So sometimes people forget that they're unmuted.
Hey, it's a new reality we're in with this whole Zoom thing, right?
I know, I hear you, I hear you. Yeah, we roll with the punches.
Yeah.
We were talking about taxes in California. Taxes, look at all the ballot propositions that are out there to raise taxes, to create more income so the government has more money to spend. Well, the bottom line is that depreciation and other tax write-offs that the government gives you reduces the amount of income tax that you pay on the rent that you collect. That is huge. Those are the 3 main areas to an investor: monthly income, appreciation, and depreciation, really, which is called tax write-offs. But here's the big question. Since I bought the property to work for me, so I don't have to, how do I get my property to work harder for me? Because if I've owned my rentals for 7 years, 10 years, they've grown in value. They're producing income. I'm writing it off, but how do I get it to work even harder than that? Well, let me show you how. How do I grow it? Well, let's say each one of us own 2 properties. We bought them in the same month of the same year. They're on the same street in the same city. They're the same square footage, the same condition, same floor plan. Nothing is different. And each one of you own 2 properties. The first property you own is, we're going to call it property A. The second one you're going to own is property B. There's really no difference except for one thing. Property A has more equity. It could be completely paid off or just a lot more equity than property B. For whatever reason, maybe you paid it off faster, maybe you refinanced B or something. But the bottom line is A has a lot more equity than B. Are you with me? You own both of them. Now, let's compare. Let's talk about the 3 things that mean so much to us. Number 1 is income. Remember I said earlier, income is divided into 2 categories, cash flow versus rate of return. Well, let's see which property pays us, number 1, the highest cash flow. Would it be A, that has more equity in it, or B, that has less equity in it? Remember, they're the identical properties on the same street in the same city, the same floor plan, same condition. So the same square footage. The answer would be property A will cash flow better. Why? Because I have less debt to pay each month in terms of a mortgage payment, which means I get to keep more of the rent that comes in. Make sense? Property A wins this part of the battle. The other part is called the rate of return. Which property gives me a higher rate of return based on the amount of equity that I have in the building? The answer is B, almost every single time. Why? Even though B has far less equity than A cannot charge more rent than B can because they're identical properties. They're in the same street in the same city. Rent is not justified or created by how much equity I have in the building. It's based on fair market value. And the bottom line is B can charge as much for rent as A can, but B has far less equity to be able to get to that charging of rent. So the bottom line is the actual rate of return on the amount of equity that you get based on what you can charge is definitely the B's the winner. And any good sophisticated tax person or financial planner will tell you the same thing. So B wins the rate of return per investment. Number 2, which property will appreciate faster? A, that's paid off or close to it, or B, with far less equity? The answer is Appreciation has nothing to do with how much equity you have in the building. Appreciation is based on the building itself and what they're selling for. And the bottom line is B that has far less equity will appreciate the same amount as A will. So B is still giving me a higher rate of return, but they're both appreciate equally in terms of the buildings. Number 3, which property will give me a better tax write-off? Remember, these are the 3 things that really matter most: the income, the appreciation, and the tax write-offs. The answer is, well, they're going to depreciate at the same level because they're the same square footage on the same street in the same city. So they'll depreciate equally. But A's got something, B has something that A does not have. And you know what that is? That precious interest write-off with no limit. Because it's an investment property, you can write off 100% of the interest that you pay. You know what that means? That means your rate of return because of this write-off is even higher on B than it is on A. So what's the key to A? How do I make A work harder for me so I don't have to? Well, if I'm under my 60s, probably a good way to do this is to releverage A. I can releverage the equity in A, so A then can create 2 properties, or I can sell a single family and buy a 4-unit property, or however I want to distribute it. The bottom line is it'll create more cash flow and rate of return, especially rate of return. It'll take the equity out and spread it out so I have more doors that are going to pay me rent each month. It'll also spread it out so now I have multiple properties that'll be appreciating, not just one. And the last thing is I'm going to have multiple write-offs because I'm going to have multiple doors. Folks, that's how people make money. Now, I want you to think about this. They buy a condo, they let it appreciate over time, they sell it, and then they buy a duplex. And then they wait, same thing all over again. They wait for time, it'll appreciate, they'll take the equity out of it, refinance and buy or sell it, and buy a 4-unit or a 5-unit or 6-unit building. And that's what people do. They make the equity work for them so they don't have to. And that's what happens. That's how people make money off of investment real estate. And that's how they increase over time their income, their appreciation, and their tax write-offs. They're just simply releveraging. Now, let's say you choose the option of selling, and that's what a lot of people do. So my question is, how much will the government charge me in taxes if I sell my property? You know, anytime you sell anything of value especially it's gone up in value, the government wants their part. Remember we said the government wants your money, those 5 words? Well, the bottom line is, I'm going to show you how the government tax. Now, this is not to teach you tax rules or tax laws. You should always go to a qualified CPA or an enrolled agent or a tax attorney. These people know what they're doing in terms of finding out how the taxes work for your particular property. You should never try to do this if you don't have a license. But the bottom line is this. I'm here to give you a flavor. It's like a little test flavor when you go to like an ice cream shop and they'll give you those little spoons and they'll give you a taste so you can get a flavor of it, find out if it's for you or not. Well, this is what I'm going to do for you. How does the government determine how much taxes I pay when I sell a property? Is it based on the equity in the building? The answer is never. It's based on something called a capital gain. And how does the government determine that? Here comes the taste of your flavor. Number 1, they look at what you sell the property for. Number 2, they subtract what you paid for the property. And number 3, the difference is your capital gain. But it's not quite that easy or that simple. What happens is the sales price minus what the government calls the adjusted basis equals the capital gain. What does that mean, the adjusted basis? Well, what it means is basically this. Your CPA or your tax person, your enrolled agent, your tax attorney is going to take this basis thing that they're going to create, and they're going to be created on some of what I'm going to show you right now. Number 1, how much did you pay for the property originally when you bought it? You know, A or B. In this case, you're going to releverage A. So let's say you bought it for $300,000. Well, that's the initial part of setting the basis of the property. But it isn't $1 million minus 300 because the basis has to be adjusted each year by the CPA based on what? Number one, your capital improvement. So if you've put money into the property in terms of a capital improvement, it actually raises your basis and it creates additional tax write-offs. So for example, if I put money into my bathrooms or upgrade the kitchens, or if I change out the windows and put double pane energy efficient windows, if I add on, if I put on solar heating or whatever, you know, a new roof, a better roof, all that is called a capital improvement. We're not talking about paint. We're not talking about carpet. We're not talking about repairs. We're talking about actual improvements. So if I put $100,000 in capital improvement, it raises the adjusted basis from $300,000, which I paid for the property, to $400,000. Number two, they're going to deduct depreciation because depreciation is a benefit that you're taking. So the government will have your CPA lower the basis because of that. The lower the basis, the higher the capital gain. The higher the basis, the lower the capital gain, the less you pay in taxes. And that's basically how it works. Next, they're going to look at your closing costs. For you to sell the property, to do a 1031 exchange, or just to sell the property at all, you have to pay fees, one-time fees to sell the rental. That would be commission to the agent that you hire, like one. Escrow. You have to have an escrow company escrow the sale. You have to have a title insurance policy that you have to provide for the buyer. You have transfer taxes. You have recording fees. You have exchange fees. That's me. You also have something that you may have to pay to repair the property that the buyer catches on an inspection. Or they may ask you to credit them for whatever reason because something needs to be done in the next few years. And if you agree to do so, to pay for this, whether you give them a credit or whether you actually do the repairs themselves, those are called, because they're contractual conditions of sale. It's a one-time cost to sell the property. Therefore, the government will adjust or your CPA will adjust the basis because of that. So let's just say, even though I bought it for $300,000, my adjusted basis is $400,000. So they'll take number one, the sales price, subtract the adjusted basis, which is number two, and that leaves you number three, and that's called your capital gain. And that, ladies and gentlemen, is what the government is always fighting about. How much do they charge you in taxes on your capital gain? It isn't true just of any election. It's really true of this election as well. So only, like I said, only your CPA should be able to do this for you. You just don't arbitrarily try to do it yourself. Now, next question is, now that we know that we have a $600,000 capital gain, how does the federal government treat it? Well, if it's your principal residence that you're selling, the government, and you qualify for what they call the 121 principal residence exclusion, if you're single, the government will allow you to take up to $250,000 off that $600,000 gain. That means you'll pay taxes on $350,000 of the sale of your principal residence as a single person. If you qualify for the 121 exclusion and you're married filing a joint return, then the government will take up to $500,000 of gain off your capital gain. So if you get the whole 500, 600,000 of gain of your property sale, your principal residence, minus the 500,000 that they'll exclude because you're two people. Now you pay taxes on $100,000 of capital gain. If this is your second home or your vacation home, you won't be able to take a 1031 exchange, or you won't be able to do the principal residence exclusion because it's not a principal residence. So you will pay 100% of the capital gains taxes off your $600,000. And by the way, just you see under C where it's in red, where it says deduct depreciation, you're not allowed to depreciate your principal residence or your second home or your vacation home. So that doesn't even factor into it. Thirdly, if it's a rental property, you have an option to sell and walk away and pay the taxes on the capital gain. And let me show you what they look like. Oops. Sometimes my mouse goes hyper on me. Here we are. Number one, off the $600,000, you will pay between 15 and 20% as your capital gains tax to the IRS. 20% of what? Of the $600,000. That's number one. Number two, the second tax you get to pay is the healthcare program. Some people call it the Affordable Health Care Act. Some people call it Obamacare. It doesn't matter what you call it. What matters is that after $200,000 of gain, if you're single, or $250,000, if you're married, you pay an additional 3.8% to the federal government for the healthcare program. Number three, the state of California wants a tax. It's going to be somewhere between 9 and on the high end, 13%. So you will pay that on the $600,000. That's applicable to number one, number two, and number three are applicable to your principal residence, your second home, or your vacation home. That makes sense? You get the gain exclusion off your principal residence if you qualify for it under Code Section 121, and that you'll need to check with your CPA if you qualify for it. But the bottom line is, on a second home or vacation home, you pay 100% of 1, 2, and 3 on the gain. If it's your rental property, you pay 100% on 1, 2, 3, and then they add in number 4 because it's a rental. Because they allowed you to depreciate it, the government says you have to pay them a tax on the tax write-off they gave you. So if you're able to depreciate it over 10 years, 12 years, 20 years, 27 years, whatever the allowable depreciation was, the government goes back and your CPA will charge you or write in the figure of 25% of that you pay an additional tax. Not based on your gain, but based on the allowable depreciation. Now, what if you say, well, I didn't take it because I really didn't need the tax write-off? Well, that's fine, but you'll still pay this tax, even if you didn't take it, because you were allowed to take it. And that's how the federal government has set it up. Does that make sense? So what are the other options to sell my investment property if I don't want to do this? And if I want to releverage to create more cash flow or income, appreciation, tax write-offs. Do you have a question, Juan?
Yeah, real quick on depreciation. So basically, you're getting taxed on the depreciation whether you're taking it or not, correct?
If it's a rental.
If it's a rental.
Or investment or business use property, yes. And you have the option to take it or not take it. But whether you take it or not, the government says you still have to pay that tax.
So you might as well be taking it if
Absolutely.
you have, right.
No doubt about it. So what's a 1031 tax deferred exchange? It's a real estate transaction where you sell the property to re-leverage it like we just talked about, taking the equity to buy more doors, to create more income, appreciation, and tax write-offs. The government allows you to do this, to sell and then buy for the purpose of deferring capital gains tax. It's not tax-free. It just lets you not pay the tax, take the basis with you, take the capital gain with you to go into better property for you. You may want to go because you want to go into a different city or a different state. You may want to do it because you're looking for more doors that are going to create more income for you. You may want to do it because you want to leverage it out and not put all your eggs in one basket, so you could have multiple properties that'll go up in equity over time. Or you want to buy up to create additional tax write-offs. But that's what a 1031 exchange is. It's the sale and the purchase of other investment real estate to defer capital gains taxes. Do I eventually pay the tax? The answer is absolutely, because the government wants their money. If you later sell and not do another 1031 exchange, but you can literally exchange every 2 years. If you're selling a property in Pasadena and you're going to buy one in Cerritos, you can do that. Sell Cerritos 2 years later or beyond and buy something in Buena Park. You can do that. You can later on take it to Riverside. You can continue to keep exchanging. And what happens then? Well, if you keep the property or the properties or go into other types of properties that are going to be better for you, because what do you want when you go to retire? More income, right? And that's where the cash flow thing comes up. That's when you want to start paying down the properties if possible. And the bottom line is that you continue to make income in your older years, but now it'll be even bigger. And if you have the property in a trust or some other type of vesting, which the government allows us to take, that means that if I pass away in my trust, my wife gets the property and or my heirs, like my children, for example, will receive it at a stepped up basis. Now, what is that? Well, a stepped up basis means that I paid originally 300 and I've done a couple of exchanges. Now I'm sitting on $5 million worth of properties after all these decades. And now it goes to my family, not at my $300,000 basis, adjusted basis, but it goes to them at a stepped up basis. And the word stepped up means this: whatever the value of my property is on the day that I pass, that becomes my wife's or my heirs' new basis. So when they sell the property if it's worth $5 million and they bury me and, hopefully mourn my life a little bit, lower my loss of life, and then sell the building for $5 million, there's no capital gain because the basis got stepped up to $5 million, the value of the date of my passing. So the $5 million sales price minus the $5 million basis equals a zero capital gain. That's at risk right now in this election. I don't know if you know that. In the presidential election, you need to check it out before you vote and see if this is important to you. God bless America. We get to vote however we want. And whether you agree or disagree, it doesn't matter. What matters is that you do take the time to find out everybody's position, all the propositions, the state measures, and the federal measures, or in the federal election. You get to make up your mind. And this is at risk right now, if this means anything to you and your client base. So the bottom line is you do need to be involved with your CPA and for sure an estate planning attorney who can set up a trust and review the way you can take advantage of the tax laws so that you could benefit more out of the properties you worked so hard to buy and take care of all these years. So how do you set up a 1031 exchange? Well, one will call me. Well, first of all, he'll put language in your contract to say that you're doing a 1031 tax deferred exchange, and then get a company like ours, which is called an accommodator or a qualified intermediary, to facilitate your exchange. The IRS says without a company like ours, you cannot do a 1031 exchange. So they'll put in the necessary forms from the California Association of Realtors. They're called ZIP forms. And they'll set up the exchange between a company like myself and the escrow company before escrow closes. I got a call last week from escrow. I get 2 of these a week, it seems, where the escrow officer calls me up and says, look, the guy meant to set up an exchange. He did not do it. Escrow just closed yesterday. Can we do an exchange? The answer is no. The government will not allow us to backdate, and we cannot set up an exchange in those situations. So it's considered as tax fraud. So you can't do it. So the bottom line is the exchange has to be set up between a company like ours and escrow before escrow closes. So as long as escrow hasn't closed on anything, we can set up a 1031 exchange. Next, which properties are eligible for a 1031 exchange? Did you know there's only 3 properties eligible? First of all, does it say residential on this list? No. Does it say commercial on this list? No. Does it say industrial properties on this list? No. It doesn't say any of that. So if you own real estate, real property, and your real estate is involved in one of these 3 things, like generates income, or you charge rent, or you use it in your business, like you have a factory, or you have a commercial building, or whatever it is, and it's for your business, or you have vacant land that you bought to hold for appreciation, then your property qualifies for a 1031 exchange. That's all it is. that could include any of the commercial, residential, industrial, vacant land. It's just property that you're holding for investment. What cannot be exchanged? Never. Your primary residence. You have the 121 principal residence exclusion of gain for that we just talked about. Your second home or vacation home are not exchangeable. You can convert these into rentals. You have to wait for 2 years and declare the income and begin to depreciate on your tax return, which your CPA will do for you. But in themselves, they are not exchangeable unless you convert it and hold it as converted properties into rentals for at least 2 years. A business cannot be exchanged. The property can be, but not the actual business and the assets of the business and the inventory of the business and the goodwill of the business cannot be. How about flipping? Most CPAs say no. Some say yes. It depends on every situation. So that's why we tell them, go talk to your CPA, see what they see, and see if they feel that it qualifies.
Phil, before you move on, I got a couple of questions for you.
Thank you.
So the vacation rentals, let's say that you're doing an Airbnb and using it as a vacation rent, like for your personal use, like on a, a couple weeks, a year or something like that. Does that count as a rental?
One, that's an excellent question. If you own, as an example, an Airbnb, or you have a property down by the water or in the desert or in the mountains, whatever, the government says you could actually utilize it for personal use on a limited basis. Now, what does that mean? Well, limited to the IRS says this. You have two options. You can take as many as 14 days a year. That would take care of your 2 weeks right there, right? But they say if you rent the property for more than 140 days a year, so for example, let's say you rent it for 200 days, the other 165 days it's vacant, then they'll allow you to take 10% of the time it was actually rented as personal time. So if you rent it out for 200 days a year, you now get 20 personal days a year. If you rent it out for 300 days a year, you now get 30 personal days a year. So you can utilize it, but only to those limits. So it can still be a rental. It's not a vacation home. You depreciate it. You claim the income on your tax return. You pay the taxes on that, but now you can utilize it for personal use. That makes sense?
Got it. Yeah, totally makes sense.
Good.
Going back to the stepped up basis.
Oh yeah, that's a big deal.
Yeah, so you mentioned that if you have a trust set up, then automatically transfers to the heirs, right? What happens if the owner of this property doesn't have a trust set up? Does that still go up to the heirs, or is that gone?
It depends on the vesting. And that's why you see on the bottom where it says you must consult your tax professional or estate planning attorney for more details. You need to put it in some kind of an ownership that allows for this. A trust isn't exclusive on this, but why would somebody start a trust? Well, I'll tell you why I did, for 3 reasons. Number one, the trust gives you the ability to avoid probate after you pass. Probate is very expensive and can last between 6 months to 5 years. And the bottom line is you're going to have to pay an attorney between $300 and $550 an hour to probate. It's a lot less expensive to set up a trust with a trust attorney. I mean, it'll cost you what, $2,500, $3,000? Can you imagine how much you'd have to pay? $50,000, $60,000 to probate? It doesn't make sense, and it takes too long. Whereas this, when you die, boom, it flies into effect. And number two, it gives a stepped up basis. And trusts are great ways to go. The third reason was that not to avoid probate, gives you the stepped up basis. It also allows you to give to whoever you want, how much you want, when you want them to get it, because it can be in increments, especially if it's younger person. So the bottom line is that this trust for the price, in my opinion, I'm not an attorney. I don't sell trust. I don't write trust up. But for me, I think it's a great way to go.
I paid $1,500 for mine. So
there you go.
yeah, so
yeah.
cheap.
Yeah, it is cheap. And then you just add to it every time you buy a property or sell a property, and they just keep it up to date for you. You just have to let them know if you're selling or buying anything major like that.
Right.
Yeah, this is in jeopardy right now in this election for president. So you need to check that out, folks. It is a big deal. And the 1031 exchange is also proposed to be eliminated by one of the presidential candidates. So you need to check that out. Okay, I don't want to be charged as being political because it's not my job to tell you how to vote, but it is my job to tell you what's happening so you can make the decisions that you think are best for you. All right. So the government says that when you do a 1031 exchange, you have to go back into a like-kind property. So let's say I sold a single family rental and I'd like to go into vacant commercial land in Montana. Can I do that? The answer is yes, because the bottom line is the government says I can exchange my property to anywhere in the country. And I'll tell you right now, a lot of people are really not happy with our state and the direction it's been going and the types of propositions they keep coming up with and how heavily taxed that they are. And frankly, you know, with super majority with the state, other people don't have as much say anymore. So the bottom line is that you can go into other states anywhere in the country, but you can go into any kind of investment property. Because if you're selling investment real estate like a single family rental, you can buy vacant commercial land because that's defined as investment property, which is great. You can buy a commercial building. You can buy a 5-unit apartment building. You can buy a storage facility. You can buy a property that's going to rent out to businesses. It's whatever you want to buy that's investment real estate. It's not residential to residential or commercial to commercial. It's investment real estate to investment real estate. That gives us opportunity to expand into other markets that we think would be better for us and still maintain what the government wants us to do anywhere in the US. Now there's 5 different ways to do a 1031 exchange. We don't have time to do that today unless you want to stay with me till about 1:30 or 2 o'clock in the afternoon. And I don't think any of us want to do that. So here, I'm going to touch on the most important ones. The first one is number 2. It's called a delayed exchange. A delayed exchange became law because of a lawsuit. Somebody actually sued the United States Treasury Department and the Internal Revenue Service because they had to close concurrently and simultaneously. And they said that's not right. So they actually went, they hired a bunch of attorneys and they fought the federal government. You know that old saying, you know, you can't beat City Hall. Well, this is more than City Hall. This is the United States government that they went after in court. And guess what? After 20 years of litigation, Mr. Starker won his case. And that was the evolution of this delayed exchange. Even though exchanges have been with us since 1921, the delayed exchange didn't come into being until the 80s, the 1980s. And this is what it says. The government now says that you have to close escrow on whatever you're going to purchase from the time the sale closes. You have a maximum of 180 days. Now, 180 days is not 6 months. It's close, but it isn't. 6 months, technically, in today's market and today's year, because it's leap year, is 182.5 days. So you're 2.5 days shy. You missed the plane. The train has left the station. You're not going to get on your cruise ship because it's already left 2.5 days ago. So in other words, you have 180 days, not 6 months, to close escrow from the time your sale closes. And remember, you have to set up an accommodator to set up so you can do a 1031 exchange beforehand. So that happens first. Number 2, you close your sale. Number 3, you close whatever you're going to exchange into for more cash flow appreciation and tax write-offs up to 180 days later. That's not bad. That's almost 6 months. Not quite, but almost. It's 180 days. Number 2, the government says you have to name the address of what you're going to exchange into before the end of the 180 days. You have to name that address of that property in the first 45 days in writing. It has to be an official identification in writing with signatures. Now, under the 3 property rule, the government will allow you, you'll see that as a bullet point just under the purple, up to 3 properties. It's called the 3 property rule. That means you can have 3 different addresses of anywhere in the country of what you want to buy. You can buy any one of those properties, or 2 of the 3 properties, or all 3 properties. Can I change my identification? Yes, but not after day 45. Day 45 is the drop dead deadline. It's the first 45 days of the 180 days. It begins as well at the date of close. So let's see, today is the 28th of October. If I close escrow today on my rental and I have my accommodator set up, tomorrow is day 1 of 180 days, which is the 29th. Tomorrow is also day 1 of the first 45 days. So I have to make sure that I stay in compliance to this. Some people say, well, does the government give any COVID extensions because of this pandemic? The answer is yes, they did, but they expired back in the middle of July. There are no more COVID extensions. And frankly, I don't anticipate the government's going to grant any more extensions. So that's really the basics. There's a second rule called the 200% rule, but that's if you're going to go into agricultural land, or you're going to go into other like a ranch land or desert property or mountain property where maybe the values are much less and you need more than 3 properties to fulfill your exchange, because you'll find out in just a minute, you need to buy for equal or greater in value. And sometimes you need more than 3 properties to do that. So the government will let you go into that rule. 99% of the people in the big city are going to use the 3 property rule if they're going to stay in a big city. There's also something called the reverse exchange. I don't want to spend a lot of time on this because I could spend a tremendous amount of time on a reverse exchange. What happens if you find something, a property to acquire, and it's an incredible deal, and if you don't jump on it quickly, you're going to lose it? Well, you don't have time to prepare and sell a property. You have to close a purchase first, or you'll lose the property. But you'd like to sell something else you have to go into this. Well, the government let me do the exchange backwards. Will they let me buy first and then sell? The answer is yes. It's called a reverse exchange. And all a reverse exchange allows you to do, again, you have to have an accommodator to do this. But it allows you through the accommodator to close escrow on your purchase first, which means you're going to have to float money, right? You have to have upfront cash, whether you cash in your stocks or you have money in the bank, whatever, you have in a money market fund, whatever. And if necessary, you bring in a lender with you, and the government will allow you to do that, to be able to close the purchase first through the accommodator. But the sale must close between 179 to 180 days afterwards, because we're going to have to take title to one of those 2 properties. The government will not allow you in the middle of the exchange to have title to both. And that's just the way the feds have set this up. So the reverse exchange works. It's more expensive. You have to float money. You'll be reimbursed of that money that you floated after the sale closes. But the bottom line is, it allows you to take advantage of opportunity. Some people don't do it because of opportunity. They do it because they're petrified that they won't find what they want to buy in 45 days from the time the sale closes. So they feel much more comfortable to buy first and then sell afterwards, because they feel in a market like this, they can sell easier than they could buy. So it just depends on your circumstance, but it is available for use. What are the IRS requirements? And we're going to begin to kind of wind down a little bit, but I want you to know these. This is a very important, the next couple of slides are going to be really important to you. Number 1, the government requires that all the cash from the sale must go into the purchase. Number 2, the government also requires that you must reborrow on the purchase whatever you paid off on your sale. So let me show you what that means. And this is, I trust this is all going to come together for you in just a second. Number one, let's say you sold for $1 million. It doesn't matter what you paid for the property. It could be $50,000. It could be $800,000. You just want to defer your gain from your sale, your $1 million sale, into a purchase of another investment property for the purpose of increased doors that are going to pay you rent, for the purpose of appreciation, or buying up to create tax write-offs, just to diversify, not to put all your eggs in one basket. Maybe, maybe not. But the whole point is, this is an example. Doesn't matter what you paid for it. What matters is that you sold it for $1 million. Now, the government says you have to pay closing costs. You have to hire one to sell the property. You'll have to pay him a commission. You're going to have to do that with any real estate agent. Number two, you'll have to pay an escrow company. Number three, you'll have to pay a title company. Number four, you're going to have to pay transfer taxes to the county for sure that the property's in. And some cities have additional transfer taxes. You're going to have loans that'll be paid off. You're going to have to pay for an accommodator. But the loan that is paid off is not part of the non-recurring closing costs. Commissions, escrow, title, transfer taxes, recording fees, and exchange fees are. So let's say it comes up to a 7% closing cost. So what's 7% of $1 million? 70,000. So $1 million minus 70,000 leaves me $930,000 left over from my $1 million sale. That's assuming I have no loan. Ladies and gentlemen, the IRS is telling you that when you do an exchange, you must buy for $930 or greater. We always say equal or greater in our industry. But what that means is equal or greater the sales price minus the non-recurring cost to sell. Number two, what if I do have a loan? Well, then the loan gets paid off at the close of the sale. So I won't have $930 left over because I have $400,000 in cumulative debt that's going to be paid off at the close of the sale. Then that means $930 minus the $400,000 of debt that will be paid off on my property that I'm selling leaves me $530,000. Does that mean I just buy a property for $530? No. It means that you have to invest all the $530 into the acquisition. And number two, you have to go back to number four. Remember how you paid off all the mortgages on your property? You are required to reborrow $500,000 because $530 plus the $400,000 of debt replacement still equals $930,000. So if you want to slice it as light as you can or as thin as you can, you sell for $1 million. In this example, you have to buy for $930,000 or more. And you can put that into one or multiple properties. But if you only have $530 coming out of the cash out of the sale, you have to replace the $400,000 of debt to get back to $930 or higher. Many investors like to buy up. But the bottom line is you can buy up by taking on additional debt or putting in additional cash. However way you do it, this is what the federal government will allow you to do. That makes sense? So let's go back to the previous slide. All the cash must go into the acquisition. You must reborrow the debt based on not how much you originally borrowed, but what's being paid off at the close of sale. Whichever one is not accomplished, or both, you will pay tax on the difference. What does that mean? So if I wind up not using all the cash from the sale, which is the $530, and I put $30,000 in my pocket, I can do so as long as I let the accommodator know. But I will pay taxes, those capital gains taxes that we talked about earlier, on the $30,000. If I don't reborrow the $400,000 of loan, and I borrow only $350,000, then I'll pay taxes, capital gains taxes, on the $50,000 I don't replace with another loan. The only way the government will allow you to not pay taxes on a loan that you have to replace is if you replace the loan with new cash that you have as an example, in your Merrill Lynch account or your Chase account or in your bank account, or you want to cash out on stocks and put that as debt replacement, and the government will let you do it. So if I, in this case, if I paid off $400,000 of debt, I have to replace it with $400,000 of debt on the new purchase. If I bring in $300,000 of new cash, now I'm required to borrow no less than 100,000, because 300 new cash plus 100,000 of new loan equals the $400,000 of debt replacement, and the government has no problem with that. Or if you just want to contribute new cash and maintain the debt into the acquisition, you can do that as well. Are there any questions on this area? Because this is vitally important. Juan, anything? No?
No, so just basically, if you owe whatever you owe on your property at the time of sale, is you'll have to take that amount of debt into the next property, correct?
Correct. And there's many ways of getting it. You can get new purchase money. You can bring in new cash to offset and reduce the amount of debt you take on. It also, the seller can carry back for you. You can assume the seller's loan. You can take the debt subject to whatever the seller's leaving you, and the government will let you do that. Any of those or a combination of those, as long as you replace the debt of $400,000 or more with any of those or a combination of those, it'll work.
Gotcha. And
replacement of all cash, but not the non-recurring closing costs, because it's a cost of sale, non-recurring, that the government will allow you to pay for.
Gotcha.
Cool.
Just real quick on this, since we're talking about the loan, you mentioned earlier that you can deduct 100% of whatever the interest on the loan is on a rental, right?
Right, but that's only for tax write-offs each year to offset the income. This is what I'm talking about now, is for selling the property to re-leverage the money to get into better properties.
Got it.
Good, excellent, good questions. Should I move on?
Yeah, anybody else have any questions? If you have questions, you can feel free to unmute yourself and talk, or put it in the chat, and we can have Phil answer them.
I'll also leave my email address at the end. You could always email me, and I'll leave my phone number on the screen as well, so you can have those. So if you feel, you don't want to share your laundry with everybody there, you could always call me personally, and I'd be happy to talk with you. So that's not a problem.
Perfect.
The other thing is, you should know, is that how safe is your money while the accommodator is holding it. Did you know that the accommodator has to hold your funds in between escrow? You cannot have any touch to those funds. If you do, it blows your whole exchange, and they go back and they make you pay all the taxes. So when you choose an accommodator, you have to make sure that they do business the way I'm going to show you. Now, this is what our company does, and a number of companies do it the same way we do, but a lot of them do not. And you have to be careful, because your money could be at risk. Number one, make sure the exchange funds the accommodator is going to hold for you in between escrows from the sale to the purchase is a single client trust account, never commingled with other people's money in one account. Never, ever, ever. Those are the easiest accounts to steal from. There's a lot of bad people out there, folks, who are using their computer and technology to steal money from escrow companies, from title companies, from real estate companies, and 1031 exchange companies. You have to make sure that it's in a single trust account. That means it's not commingled. Number two, it should never be a corporate account of the accommodator. Never. That means it belongs to them under corporate funds. That means if they mismanage their finances, and we've seen some of them who have, that means your money belongs to them. And if they go into bankruptcy, the government seizes those funds. It should never be a corporate account. It should be a client single trust account. I'm really passionate about this, because it's so important that you protect your funds and ask these kinds of questions. Number three, for money to leave the account, forget this verbal stuff. Forget an email. It has to be in writing. In other words, you can email a form. What we do in our company is we provide an authorization to release fund form, and you can fill it out, sign it, scan it, and email it or fax it to us. We get it immediately. And then we'll call you back just to verify this is you and that you have authorized this. And it's not based on the number you put on the form. It's based on the numbers you gave us when we were setting up the exchange. Very important, very important. Next, make sure they have bonding, they have errors and omissions insurance. Make sure they have attorneys on staff. You know, we have attorneys on staff that specialize in this area of the law. Some companies that are like escrow companies or title companies that offer exchange services don't specialize in this. They're into title insurance. They're into escrow. They're not into exchanges. So the bottom line is this is so important. Lastly, to end our time together, I just want to go over something with you. My question is this: what is your rate of return on your property? Have you ever thought about that? Remember we said the leveraged property tends to give you better rate of return, whereas the higher equity property gives you more of a cash flow? Where are you in life right now? Are you still building where you need a better rate of return to produce more doors? Or are you at the place in your life that your cash flow, like you're retired and you just want income? You don't want to worry about debt as much. You don't want to worry about leveraging. And both are good places to be based on your appropriate time of life. So the big way to find out what is the rate of return of your property, this is a form that you can use. Juan has the form. He's happy to share it with you. And let me just kind of go, it's just a general form. And you can sit down and talk to your CPA about this as well. It's very important that you always involve your tax counsel because this is a tax decision. It's a tax deferred exchange. So number one, how do you calculate your rate of return? Well, number one, what's the gross rent for that particular building? If that building has 12 front doors, like an apartment building, or if it's just a condo or a single family, you just based on how much that particular property is generating in gross monthly rents over the period of a year. You already give that to on your tax return on your Schedule E every time you file that tax return. Number two, how much is it costing you in actual expenses? Insurance, mortgage payments, property taxes, maintenance, utilities, other types of expenses, your CPA who has to calculate all this. There's a myriad of things that can happen that you'll have to pay to keep the property up to date and in general expenses. So number three is you take number one, you subtract number two, and number three is your net income. That's what you get to have after expenses. Number four, what's your net equity in the building? What is net equity? Equity is what you would sell it for minus the debt that's on the property. The difference, the sales price minus the debt, leaves you your net equity. So now that's your answer for number four. You put in the net equity in the building. Number five, you take the answer to number three, which is your net income. You divide it by number four, your net equity. That tells you what your rate of return is on your equity dollar. What's the percentage of return that you are getting every year, at least this last year, based on income minus expenses divided by equity? And that's, you will be surprised what it would be. The higher the equity, the lower the rate of return. The lower the equity, the higher the rate of return. Now, everybody's different, and everybody's at a different time in their life, and you do what's best for you. But the point is that how do you know what's best for you unless you know what the numbers are? And Juan can help you with that. So I guess what I want to end with today is, my name is Phil Atwan. That's my phone number. That's my email address. We are here to answer your 1031 exchange questions without any obligation to do business. That's how we do our business. I like to think of it this way. I would rather have people swear by me than swear at me. I'm not here to talk anybody into anything. I'm just here to disclose, whether it's politics or whether it's the aspects of the tax code. The whole point is that as it relates to 1031 exchange, you're smart enough to make the decision that you think is best for you. And that's why Juan asked me to come and do this for you today. And I was very honored to do that. If you have any last questions, I can stay on for a few minutes and answer those. Or if you want to call me or email me, you're certainly welcome to do that. But thank you for paying attention and being here. And Juan, thank you for all the hard work that you pulled off to make this morning happen. So I thank you for it.
Thank you, Phil. I really appreciate you being here. I hope this was, actually, I know it was very informative for everybody online. And if you guys have any questions, feel free to reach out to myself or to Phil. You can reach me at 949-400-2287, or you can also email at juan@theocagent.net, and I'll put those contact information for Phil and myself in the comments down below once I post this to YouTube. Thank you, everybody, for coming. And if you have any questions, feel free to ask them now. Otherwise, you can just let us know, and we'll get back to you with the information that you're looking for.